Hello everybody and welcome to Newmarket Partnerships analysis of budget 2012. This is simply our outline and initial thoughts on the budget, and naturally if you're going to take any action in relation to any of the matters discussed here, you should give us a call first before doing so, and our details are there on the slides. Well, budget 2012 was eagerly anticipated and dreaded, and no wonder with the backdrop. This large budget deficit that we're all aware of, and everything that has been done in this budget is really geared towards bringing that budget down and under control. The Minister did say that Ireland is making good progress towards restoring finances and is increasing in economic growth, but he made it clear, of course, as well, that the backdrop of the euro currency crisis can't be ignored. But either way, as he said, our finances must be restored, and he said this budget is designed to do that. It's the latest series of austerity budgets in reality. So what did we get? Well, no real changes in the headline income taxes, but some changes to the income tax code, as we'll see. We have an increase in VAT, which along with the new property charge is the big revenue raiser. And we will see significant changes in both capital and property taxes. And really, they are the areas that maybe won't get as much attention in the national media, but which could be very significant for you. And we will be focusing on those, together with, of course, the incentives for business and job creation. So the headline income tax changes, nothing really to report here. No fictional couples and being analysed this year to see how much better or worse off per week they are, because quite frankly there are no changes to the tax rates, bands or credits. So as regards tax deductions, your salary slip in January should look no different to your salary slip in December. The one big headline grabber here though is USC reform. This applies for those earning less than $10,000 per annum. They are now exempt, whilst in the past the exemption limit was only $4,000. This really applies to seasonal and part-time workers. Anybody who's working full time will probably be over that limit anyway, and there are no USC changes for anybody who is above that limit. Capital taxes though has been changed significantly. We've seen in recent years both CAT and CGT increasing gradually from 20 to 22 to 25, and this continues yesterday. They are now at 30%. Likewise, the CAT thresholds have been slashed in recent years, and this continues yesterday in the case of the Class 1 threshold, that's the parent-to-child gift and inheritance tax threshold, which has been cut from €332 to €250,000. To put it in perspective, 3 years ago that reached a peak of €551,000. So a significant reduction over the past couple of years. Now, retirement relief is an area that was changed significantly yesterday, one of the big technical areas that you might want to consider. Broadly speaking, retirement relief is a reduction in, or in some cases exemption from, capital gains tax on the transfer of certain business assets, such as shares in a family company, if you've owned them for 10 years, and if you're over 55. We were expecting these reliefs, the scale of their generosity to be reduced, and indeed they have, but only for the over 66s. So if you're aged between 55 and 66, there are no changes, but if you're over 66, the limits have been reduced. For transfers to your sons or daughters, previously there was no upper limit, now that would be €3 million. For transfers outside the family or sales outside the family, the limit is cut from €750,000 to €500,000. This was announced as a farming measure yesterday, but actually applies to all types of businesses, or most of them certainly. And the objective behind it is to assist young farmers to return to the land, and particularly those who got involved in the construction sector in recent years and have now been laid off. It's certainly an area to watch out for. There will be more changes possibly in the Finance Act, so keep aware of that particular area. A surprise exemption introduced from CGT yesterday was on properties that are bought between now and the end of 2013. If you hold on to them for 7 years, any capital gain, if indeed there is property price appreciation at that time, will be exempt from capital gains tax. And that's part of a measure of property, part of a package of property measures that the Minister introduced in yesterday's budget, and we'll look at those in more detail later. Turning to business taxation. The 2008, the first austerity budget if you like, introduced an exemption for new start-up companies. It was applicable for any newly incorporated company that carried on a new business, and that has been extended now for another 3 years to 2014. Potentially allows you to claim up to €320,000 worth of profits in each of your first 3 years without a corporation tax charge. Could be of particular interest to certain sectors. For example, people perhaps such as tradesmen who've been laid off in recent years and who now want to start up on their own. They might look at a structure around a new company and availing of this relief. The R&D credit is something that's been in place since 2004, but has come in for some criticism in terms of claiming it that it's somewhat cumbersome and restrictive. There have been changes introduced over the years. One that was introduced yesterday that people will welcome is that the credit will be given on an actual basis for the first €100,000 of annual spend now, as opposed to the incremental basis formula that exists in general. It's a credit worth 25% incidentally. The rules have also been relaxed, and you may also now use your R&D credit to actually pay a bonus of sorts to key R&D staff. Now, the bonus will be subject to income tax, but I think the point the Minister is making is he's effectively making money available now to incentivise your R&D staff. And effectively his objective here is to encourage more R&D, and in particular to encourage companies that are delivering and are doing well to do even better and to maximise their potential, and ultimately, of course, to bridge the gap in the public finances. Same idea lies behind the tax incentive scheme, the foreign earnings deduction for employees sent to BRICS countries. BRICS in budgets in recent years would have meant something along the lines of the property market. Now BRICS means Brazil, Russia, India, China and South Africa. Send your employees there for 60 days in a tax year, and effectively their earnings in relation to that foreign service will be ignored for Irish income tax purposes. And a similar scheme is to be introduced to encourage the relocation of key talent into Ireland. Other employment measures of note: statutory redundancy rebate is cut from 60 to 15%, so that is significant, but also to discourage absenteeism, the first 36 days of illness benefit will now be taxed. So always important to keep aware of not alone tax changes, but other changes in the areas of employment and business. Turning to indirect taxes, the big revenue raiser. 21% VAT rate goes to 23%, but the Minister has stated that, contrary to the IMF Memorandum of Understanding, it won't go to 25%, and he's also reaffirmed his commitment to the 13.5% rate, and indeed to the special 9% rate which will be in place for the next year and a half for tourist type services. Indeed, he's commended the success of that particular tax rate. Turning to the old reliables, cigarettes are up by 25 cents per packet, but alcohol untouched by excise duty increases, although the VAT charge will of course apply to that. The new household charge of €100 per annum is very significant, because that will increase over the next couple of years, and by 2014 will be based on the value of your home. This is all about expanding the property, the tax base, and creating a sustainable source of revenue for the government. And finally, carbon tax goes from €15 to €20 per tonne. And now everybody is asking about, what about the motor taxes when we're in this area? And of course there are changes. Motor taxes increased depending on your vehicle's emission rating. The lower bands actually got a bigger increase in this occasion. But overall everybody gets increases between €28 and €69 per annum. And of course, back to more old reliables, petrol and diesel up by about £1.50 per litre. Now we move on to the taxation of investments, where we've had some interesting changes. And we'll start with pensions. Now, the IMF programme was suggesting that there would be a cut in the level of tax relief on personal pension contributions, eventually down to 20%, and that process would start this year. The Minister has said, in light of the contribution made by the pension levy introduced mid-year, he's not going to do it this year, but he signalled strongly that he will do something in this area in 2013. But there are other changes, because pensions have been a reliable source of increased revenue for the government in recent years, and there's always the temptation to go back to the well. So employers' PRSI relief is now fully abolished. Also, in an ARF, large valuation of ARFs worth 2 million or more, the annual distribution imputed on which a tax charge will be made has been increased from 5 to 6%. And finally, an ARF inherited by a son or daughter over 21 since 1999, that's had a flat tax charge of only 20%. That's increased to 30%, as the Minister wants to encourage a sort of an effective minimum tax rate of 30% for high earners. Property taxes, headline grabber here would be the commercial stamp duty cut from 6 to 2%. Well, it would certainly be the headline grabber for businesses. But for homeowners and for the popular media, it's the increase in mortgage interest relief for those who bought their first home between 2004 and 2008 to 30% that will grab most attention. He's also confirmed that mortgage interest relief would be available for purchases made during 2012, and that's a measure to try and kickstart the property market. It will go for purchases after that. But the most interesting thing is perhaps the reversal of Budget 2011's controversial proposal to reduce or eliminate effectively property relief, such as Section 23 and capital allowances schemes. Budget 2012 now says that instead of that those with incomes of less than €100,000 per annum, these changes will not apply. Because the report that was commissioned to inquire into the effect of these proposed changes suggested that those people were in danger of going insolvent. Finance Act will look in more detail at those who earn a gross income of more than €100,000 per annum, but for the time being is confirmed that there will be a 5% surcharge on the sheltered income for those people. That's the income sheltered by the property reliefs. Finally, for other investment measures, PRSI will apply on all sources of investment income for everyone now, but only from 2013, whilst DIRT and the exit tax on certain insurance products has increased by 3%. So in summary, it's the consumption taxes you need to focus on maybe, but maybe in more general terms, you need to look at your tax planning, perhaps even before year end. And that's why you should turn to part 2 of our presentation, where we look at some tax tips.